radical problem deserves a radical solution. My argument is that radical solution is just cutting up the credit cards and not using them anymore.
It's interesting, after 1970s, we went off of the gold standard. And so since then, we've been printing currency, which is, cash is actually not a store of value anymore. And literally on the cash, it says Federal Reserve note. At the end of the day, these are just debt notes. Whether you spend cash or whether you swipe a card, they're just two different ways of using debt.
That was an interesting argument that I've never heard before.
Why are you paying extra on your 15-year mortgage and not just putting it into a high yield savings account when you're earning more? And you'll actually pay off your home faster if you just did that versus paying off a 3% debt.
Honestly, it all comes down to consistency. I have a specific audience that I'm talking to. I don't ever want to come across as being hypocritical. I'm trying to help people who are really hurting in significant ways change their personal finances for the better.
Do you agree that there's a difference between good debt and bad debt, or is all debt for you bad debt?
So,
hey everybody, I am here with Caleb Bale. Loving your name, man. Very, very grateful that you're coming on the show, and we are going to have an amazing conversation around debt, around credit cards, around 15-year mortgage or less versus a 30-year mortgage. And what we were just talking before we hit record is we appreciate having just a great conversation. I think sometimes in a world where people are going for clicks and they want to get the get yous, I think it's really important to be able to sit across the table with some people that disagree or maybe have different opinions, and to be able to lay out this is why I believe what I believe, and here at this point, because regardless of who you are listening or watching, it helps elevate your financial IQ and helps increase and the hope is to have greater financial conviction. And so, Caleb, I have been a fan, a short fan of your work, because I've been aware of your channel on YouTube, which is coming up on 10,000 subscribers. Congratulations on that. And you have lots of great content. And our team made me aware of what you do. And they were like, Caleb, it would be amazing if you had a conversation with the other Caleb. It's like Caleb versus Caleb around all things debt and your philosophy. And so before we jump into the format, is there anything that you wanted to say before I explain kind of the format of this video?
No, this is great. I'm excited. I'm excited to talk.
All right. So the format is you're going to have 5-ish minutes to kind of talk about your philosophy when it comes to all things debt. You can touch on credit cards, you can touch on, 15-year mortgage versus not. You can kind of just give your the Caleb thesis, or we'll call it the Bale Bale thesis when it comes to how you view debt. And then I'll give a 5-minute-ish deal when it comes to, I actually have 7 points that I want to quickly make. And then what I would like to do is kind of go back and forth. It's there's going to be points that you made that I would probably, love to have a conversation around, vice versa. And then what we have is really talking about three points after that. Is there such a thing as good debt? We can delve into that. Then the second thing is credit cards. Are they harmful? Are they more harmful than good? So we can have a conversation about that. And then number 3 is around, should you pay off your home with cash? And essentially is paying off your house as fast as possible better than maybe creating a 30-year mortgage scenario? And we can touch on all those things. And if there's something that comes up in between now and then that we want to add to that list, great. But I have a feeling that there's going to be a lot more topics that get discussed as well as you and I create kind of our opening theses. Anything that you want to say before we jump in?
I don't think so. Yeah.
Okay. Well, Caleb, I will give you 5 minutes, and I'm going to be taking notes. And again, I really appreciate you coming on the show and being willing to have this conversation.
Yeah, absolutely. Thank you for having me. So I think a lot of someone's significance behind someone's perspective comes from kind of where they're coming from, their background. So brief introduction. I'm Caleb Bale. I got into personal finance when I was in college. I had an engineering internship, and I was just looking for a podcast where I could just listen, pass the time as I was doing my work. And so I found the Ramsey show, and really kind of got engaged in that and thought that it was really interesting. And then that same year in 2016, my wife and I got engaged, and I was like, holy crap, I need to figure out this whole budgeting thing before 6 months are up, so that we can go into our marriage, having like a solid financial background, So, ended up, 6 months later, we got married. We had a budget set up. We used that to pay off my wife's student loans, and then cash flow everything for the rest of her education beyond that. And we also took FPU at the time, Financial Peace University, and ended up deciding, let's try this whole living without any credit cards thing. And so that's what we did. We didn't use any credit cards, but we also didn't cut up the credit cards. And then in 2019, I led Financial Peace University at my church and also became a certified Ramsey financial coach, because I just found the more and more that I got into this, that I just really enjoyed the content. And that was the point at which we actually decided to cut up our credit cards. So we, up to this date, have not used credit cards in the last 8 years. And around that time in 2020, I started a YouTube channel that was, specifically, I was trying to grow my own knowledge by sharing knowledge with other people, while also kind of, marketing my coaching. And so if you look at my channel right now, you'll see that a lot of the content focuses on, reviewing cashback debit cards. And the reason for this is because, in my opinion, credit cards are a massive problem in America. By the numbers, 48%, according to Bankrate, 48% of Americans have revolving credit card debt. So not just a balance, but a balance that they carry from month to month. And thus is, that's the balance that they're actually paying the interest on every month. According to NerdWallet, the average American household that has credit card debt actually has $10,563 in revolving credit card debt. So that's, again, credit card debt that they're paying interest on every month. So by Bankrate's recent calculation of the average credit card interest rate being over 20%, then that's like over $2,000 every year that these people are paying in interest. And if they're just paying minimums, then it can take 4 to 5 years to just totally double the balance that they have in their credit cards, which is just insane. So, but really honestly, like it's no wonder that so many people do use credit cards and actually carry that balance on a monthly basis, because Bankrate finds that, according to one of their recent studies, that 60% of Americans actually can't cover a $1,000 emergency fund. Meanwhile, people have tons of payments. They're dealing with an average new car payment of $700. Student loans are at an all-time high. And then, of course, mortgages have gone up massively in the last few years. And according to NerdWallet, again, nearly 60% of Americans live paycheck to paycheck. And on top of that, like 42% of Americans that earn six figures also consider themselves living paycheck to paycheck. Debt is like this massive problem. And I personally believe that credit cards are kind of like at the forefront of this problem, because it's touching people's everyday lives. It's like, yeah, you live in your house that you have a mortgage. Yeah, you drive your car on a daily, maybe a daily basis. And yeah, you have this education that you're using maybe at your job, but like credit cards are what people are using to buy groceries and to pay for bills, that kind of thing. A radical problem, and this is what I would consider a radical problem, deserves a radical solution. And my argument is that that radical solution is just cutting up the credit cards and not using them anymore, closing out the accounts. I think that I don't deny that people are in a tough situation nowadays. I don't deny that that it's challenging, especially with inflation and everything. But I also want people to understand that the only way to stabilize themselves is by stopping the bleeding, by getting on a budget, by controlling their spending, by increasing their income, and by paying off debt. And credit cards have been marketed as normal far too long. And I think that it's really hurting people. So I tend to recommend, or I always recommend, that people get rid of their credit cards, because I think that there's a massive positive to not having credit cards and instead using cash or debit cards. A couple things. There's no chance, obviously, of getting into debt if you're using cash or debit cards. Statistically, you're more likely to spend less, which I think is a huge thing, because, if you're paying for cash, there's like physical pain that your brain experiences when you hand over that cash, and when you're paying even with a debit card, that there's like something leaving your bank account, so there's like a change in your bank account versus just, just hand over the card and you get it right back. And then I'll pay for it later. I'll figure out how to pay for it later. Paying with a debit card also forces you to be more careful with your finances so that you can cover emergencies with cash. And I think it's a lot easier to actually track your spending, especially if you have a budget. I remember when my wife and I got married, the last time that I used my credit card was the month before our wedding. And and after we had gotten married, we went on our honeymoon, came back, and then had a $700 credit card bill that I needed to pay. And I totally forgot that I still had that to pay. And I was just like so annoyed, because I was like, oh man, we're like newly married. I thought we had $700 more than we actually did in our bank account. It's because I had this balance sitting on the credit card. We paid it off in time, but it was still just so annoying. It's way easier for us to track our finances, because we aren't trying to keep track of, a balance that we need to pay off at the end of the month. Debit cards also have, a lot of benefits. They have fraud protection, just like credit cards. I'll say that this is probably the only thing that is maybe the biggest deal for me is I think the fraud protection may be something that people are really motivated to have the credit cards. But debit cards still have fraud protection. They still have rewards. You can still use, cashback debit cards and earn from that, or at least get some sort of kickback. The main thing I think is just that credit cards tend to be seen and used as a crutch. And I want to show people that that doesn't have to be the case.
Caleb, thank you. I really, really appreciate you breaking that down. That was 10 minutes. And I just appreciate just not only your backstory, but all the points that you made. I made note of some of them, and I'm excited to dive in. So I'm going to take my time, and then I'm excited to have conversations on some of the things that we chat about. So I have really seven things that I want to just point out when it comes to debt. And I think even what you mentioned, Caleb, you made some really good points, and you'll see that I very much want to acknowledge both sides in this. But I obviously am on the side of essentially saying that debt is not a bad thing or we shouldn't necessarily get emotional about debt or the use of credit cards. And so at the end, I'm going to actually talk about my framework on how I go about good debt versus bad debt and how we'd go about purchasing something, because I think it's important. I think sometimes on both sides, people, you even use like Robert Kiyosaki. He'll be like, debt is good, and like you just use debt to buy assets, and that might sound really good in like a tweet or in a book, but could be like, it's like, okay, how do you actually get financially free? Sometimes it could be more complicated than just buying real estate. And I think in this conversation on both sides, sometimes we oversimplify it, and the reality is sometimes you have to oversimplify it. And so I want to start by saying, I just want to acknowledge the reality of there are so many people in hard times. And so the moment you give an inch, the moment you say, okay, in this scenario, it's okay, then you're ultimately enabling or giving people that shouldn't have credit cards at all. And I would argue to say they have more issues than just the credit card. I would say that there's a lot more psychological problems there than just a credit card, but the credit card doesn't help them. It's a net negative in their life. And the moment Dave Ramsey or someone like you or someone else says like, okay, we're going to like create a situation to where like maybe there's a world where not all debt is bad. And then half of America will then just take, oh, Dave Ramsey said I should use debt. And then everything that you work so hard for goes out the window. Now, with that said, I want to acknowledge that here are the 7 talking points that I have when it comes to just the other side. Number 1 is when we talk about debt, it's interesting because usually when you talk about debt, it's like debt is bad, dumb, and cash is king. Like use cash. Cash is the gold standard, no pun intended. It's interesting, after 1970s, we went off of the gold standard. And so since then, we've been printing currency, which is, cash is actually not a store of value anymore. And literally on the cash, it says Federal Reserve Note, which is super ironic to me because in a point is like, even when we spend cash, we are spending reserve notes, which is a form of debt. So the way that I want to just zoom out just unemotionally, it's like, since we went off the gold standard, whether you pay cash or whether you use debt, credit cards, mortgages, it is a form of debt. It's just there could be, it could maybe hit different. There might be safer forms of how we go about that. But I point out that cash in itself is a form of debt, and understanding just the fact that our dollars are getting less and less valuable due to inflation is the sense that we're continuing to print money. The second thing that I'll point out is the credit score. I'll be the first to say credit score doesn't make any sense to me. I think it's quite, it's always a little bit interesting to be like, why are you telling me that the more credit lines that someone has means that they have a better credit score kind of deal? I'm definitely not endorsing the credit score game. And I would love, honestly, for it to be changed or for there to be conversations about changing it. And at the same time, there is an element of you sometimes just have to play the game. I'm not like I graduated college. I'm not a fan of the college system, but in college, I realized that if I wanted to graduate, I had to get good grades. I may think right now like, oh, that wasn't needed. I didn't need to have the college degree. But the reality is, if I wanted to graduate, if I wanted to play the game, I had to show up to class and do certain things to get the GPA that I couldn't even tell you what it is now, but I had to play the game. And that's when it comes to the whole credit score. The question is, if you have a good credit score, is your life potentially better? A lot of times people say you can get a house without a credit score, which is true, but it's also logic will say that, manually underwriting for a home gives you less options than if you have a good credit score. If you have a good credit score, you can still manually underwrite your home, and I'll do that if I can get a better rate. But now more options is better than less options. The other thing is, when you have a better credit score, there's insurance. There's a potential. There are insurance companies that will give you better rates. I know that sounds crazy, but there's a world where it's like, hey, you have a good credit score. For some reason, we feel like you're less at risk because you're a responsible person. Again, I don't necessarily need to like it, but that's just one of the realities. In renting, there's a world. Why do you think in rent, sometimes they look at your credit score? It's just like, these are all the kind of things. It's like, I don't love it, but I think in a system that's like, just buck the system, there could be some negative consequences. And I would rather have like a better credit score, in my opinion, is it gives you more options and access than the person that maybe is like, hey, I don't need a credit score, but it's like, man, I would rather have a good credit score and the optionality that gives you. The third thing is a lot of times we'll say, like right now, based on my research, there's over $1 trillion of credit card debt, meaning over 20% plus on average credit card rate, which is horrible. You said the bank rate, 48% of people have revolving debt with an average debt of $10,000. Firsthand, like I hate that. That breaks my heart. And that they're literally in a hole 20. How do you get past the 20%? So I just want to acknowledge that. And I also want to acknowledge that over 50% of businesses fail. That same like logic could be like, okay, well, does that mean we shouldn't start businesses? Like, and to be honest, there's some people that shouldn't start businesses, but I can't ethically be like, well, businesses are risky, and as a result, more than 50% of businesses fail in over 5 years. So as a result, the safe option is not to start a business. And yet, for some people, that would be a really good thing for them not to start a business. I know other people, including myself, my life is radically different and changed. Not only do we get to serve people, but like from an income standpoint, it's changed my life. And so from that standpoint, another example could be like fires. Fires can be really damaging. I won't ask some cities recently who've been really hurt by fires, but does that mean all fires bad? So it's like that's where we can have more in-depth conversation, because I think there's a more to that. When it comes to overspending, I think this is the best argument for why you shouldn't use credit cards. I do think it is easy to I do think that you will spend less if you get a direct hit out of your account, but I also think that you can create systems in place like budgets and tracking. And just like I wear a Whoop band, this doesn't necessarily help me sleep better, but I tend to sleep better because I'm tracked. And so it goes back to the if the eliminating credit cards is the financial strategy, my question is like you could still be debt free and broke, or you could still be debt free and not wealthy. And so it's just like, where are we going to focus? If we want to spend all of our time focusing on not having debt, okay, I think we'll accomplish that. And I think actually we could better accomplish that with debit card. But then is the goal debt free? Is the goal to have cash flow to have in the future? And with my time left, I'll talk about credit cards. You're totally right. With debit cards, you get consumer protection. Some debit cards, you get reward points. You don't really. I think there is actually a debit card that you can start building credit. You would know that better than I do. We'll talk about that in a second. But a lot of debit cards you don't. And then purchase protection. The reality is, though, in my opinion, at least the cards that I'm looking at, I get better across the board when it comes to consumer protection, reward points, building credit, and purchasing protection. By the way, that's usually the only points people make on the subject. And I think those are weak points if that's the only points that they're standing by. But it's like if I'm already going to spend and I can juice some of those benefits, it's like right now, if I could choose a debit card or a credit card, I'm going to choose a credit card all day long for those reasons. Another example would be the Founders Card is not a credit card at all. It's literally for business owners. They can get a founder's card and they get just other benefits, and you pay and you just get other benefits. And I'm getting that for the sole reality is we use Stripe in our business. And just by having the founder's card, I'm going to save a lot more than what I pay. Same reality as what I use why I'll even go as far as to pay money for credit cards is me having this credit card going to give me more benefits? And obviously you could potentially playing with fire. Last two things in the minute I have left is my framework when it comes to debt is very simple. What are you going to purchase? And then how do you purchase that? And I think a lot of times we bundle it together. So when you're going to purchase something like a car or like a home, and I'll bundle my last two into one. If I'm going to purchase a home, I'm not going to go off of hey, what can over 30 years can I afford? I'm going to go after, could I pay for this thing in less than 10 years? Okay? Because I don't want debt to be an enabler. So I need to come up with a philosophy, whether 10 years, 7 years, 15 years, you have to make that own decision. Should I purchase this home? And the next question is, what's the most efficient way to purchase that? And for me, I want to make the decision that's going to be better for my cash flow currently and future, better for my net worth currently and future, and reduces risk. Most people do not talk about risk when it comes to debt. And I think it's one of the most important things that you can do. And, we'll hopefully talk about the mortgage. I believe you have way more risk aggressively paying off your mortgage. I know you've had videos that you're like 15-year mortgage and then pay it off faster. Gives me anxiety. I would much rather try to find a home that I could pay off in 10, have a 30-year mortgage, and I feel like not just my cash flow would be better and my net worth, but I actually think from a risk management standpoint, I'd be better off. and my time's up. With all that, want to hear your thoughts. I'll let you have the first rebuttal or questions on some of the points that we made. And I thought it was laughable that we thought 5 minutes each and we both used our 10 minutes. So I'm grateful that we were flexible enough to do 10.
Yeah. I started looking at the time. I was like, oh man, this went past way faster than I thought.
Yeah.
So I thought you made a lot of good points. One of the things that you were mentioning is like the whole more options are better. And, coming from an engineering mindset, because that's, I'm an engineer by trade, I definitely agree. More options are better for the vast majority of situations. I think the problem is that, at least when it comes to finances, if we say, it's better to have a credit score so that you can have more options. Basically one of my biggest complaints, I suppose you could say, about finance gurus nowadays is that, at least when it comes to credit cards, there's a lot of discussion, a lot of articles about like, okay, yeah, you should use credit cards. You should pay them off every month. You should use them responsibly. But every time that is said, it's said by someone who is a nerd,
I agree.
And the vast majority of America is not a nerd. People aren't nerds, or they're just massively overestimating and overly optimistic about their own self-discipline when it comes to finances. So I agree, more options are better. But when it comes to people who are overly optimistic about what they can do with those options, I think that is when it can be a little damaging.
And another way to say that is if the only pitch of why you're using your credit cards is reward points, that tells you someone is probably messing with a fire that could get out of control.
Yeah, absolutely.
What is your thoughts, Caleb, on putting people in different categories? Because it's like it feels hypocritical for me to say that half of America shouldn't have credit cards, but I actually believe that. I don't know, and it's like, oh, I caught you in a lie. Actually, no. Like, a common question I'll get is people ask, where should I invest my money? Most people should invest their money in their ability to make more. And it's like, why are you talking to me about where you should invest your $2,000 a year? Like, make more. And that might sound crazy for some people to hear, and you might disagree with that. But my point is, like, there gets to a point where that's not my advice anymore. There gets to a point where it's like, yeah, let's these are all these asset classes, but it's like there's a point that you have to understand what stage you're in. And I find that some people invest or diversify too early, and what they do is they almost shoot themselves in the foot in their ability to create. And the person that can create more money, just in my opinion, there's so many other advantages that come with that. Same thing what comes with credit cards is, it's like, I feel like for half of America, they probably shouldn't have a credit card. The other half, I'm actually cool with like maybe having a different conversation. What are your thoughts on that? Because that's a slippery slope if you start communicating that. And if you do agree with that, where would you draw the line of like who would be okay to have a credit card versus not?
Yeah. So basically my perspective is I don't have a problem if people want to use credit cards. I'm not going to be mad at you. I'm not going to judge you if you choose to use credit cards. My entire family uses credit cards, and like I talk about this all the time, but I am also aware, but I'm also never going to recommend that people use credit cards, just because I have to remain super consistent with what I talk about. When it comes to my channel, I am well aware I am not for everyone. My content is not for everyone. Dave Ramsey's content is not for everyone. Having said that, my audience that I'm going after is not people with a ton of money. I'm going after people who really are having a difficult time paying for things, who feel like credit cards are their only way to, cover an emergency, that kind of thing. My audience is much narrower and well, it's not narrow. There's a lot of people within the audience, but it's much lower in terms of like an income bracket, I suppose you could say, or in terms of their ability to budget on a regular basis. So I would say that just by virtue of what I'm talking about, I'm already segmenting people
Yeah.
into different categories.
I hear you. Do you understand the accredited investor status kind of deal, like what it looks like to be accredited versus
Yeah,
not?
yeah, vaguely.
What is your thoughts on if in your content you were like, hey, I'm talking to, if this is you, apply this, like I'm talking to you, and if this is not you, you can still use these principles and you're gonna be fine, like you're gonna
Hmm.
survive. But do you feel like that would be you would be less credible, or do you? I feel like you would be more credible if you were like, hey, I'm gonna share something that is like a must if you hit this category, which by the way, most people would hit that category.
Yeah.
And you could also make the argument, which I would love to talk about, just even what the Bible says about this stuff, because even if you're a Christian, it's like if you have convictions on certain things, like you should follow that regardless. And I've talked to some people that are Muslims, and they have very strong convictions. Like, we are not going to earn any interest on our money. Like, we're just not. That's usury. And I keep my mouth shut because I'm like, I appreciate and respect the fact that they have standards
Yeah.
and they're going to live that out.
Yeah.
And do I agree with, like, obviously I don't think I'm okay with the bank giving me a high yield savings account giving me interest.
Hmm.
So it's like there's a who you're speaking to. If you were to give a category of like, okay, listen to me, but like if you're over this, still should listen to me and definitely subscribe to my channel, but you would be okay not like, or like that. I'm just kind of giving you on my channel. This is
Yeah.
obviously, you can create a clip if you want. I'm just giving you like in the back of your head, like, I think for you, no matter how much money you make, you're going to stick to your values. But is there a difference in your head of like, if someone hits these certain things, like I'm actually okay with them spending a credit card versus a debit card?
Um, I think at least when it comes to content creation, it's much easier for like, yeah, maybe that would give me more credibility. I would say that at least from a content creation perspective, there's so many people that already fill that space. And I think it's a lot easier for me to just be like, okay, these are the people that I'm talking to.
Right.
And drawing that line in the sand makes it a whole lot easier
I
for
get it.
me to know that
Yep.
everyone that's watching my content knows exactly where I stand.
Yep. So I can say, if you have a credit card balance, you and you pay credit card interest, you should not have a credit card. I'll
Yeah.
go that far. And I have people that would disagree. I have friends that would disagree with that. If you're paying interest on credit card debt, that's like the trigger for me to say, hey, don't worry about points. Like, let's cut this off. For you, do you have on the opposite? And you don't have, you can say no, but is if you're like or because I know with your content's one thing, but is there a point, or is it the, hey, I'm gonna, there's really not a point that there's not a point that I would argue the other side.
Yeah. I would say that there's at this point, there's probably not a point at which
Okay.
I would argue the other side.
Okay, great. Let's talk about the credit card, like the well, I think we talked about the point from a standpoint of the debt being a problem, and I think credit card debt's a problem. So I think that the fact that college students get credit cards in the mail, problem. And I think that, just like at the time of this recording, there's certain things that the FDA is doing with taking certain stuff out of kids' foods, which I am a fan of. I think that there could be a conversation to say like, hey, maybe sending credit cards to 18-year-old kids, yeah, is very problematic. Like,
Yeah.
so I'm totally in favor of having a conversation around that, and would recommend young kids be very, very cautious. And I will give you this, that I think there could be more damage for young people using credit cards, especially if you're in college. You may or may not know what you want, and there are some people that literally just think like this piece of plastic is a ticket for me to buy stuff.
Yeah.
And so what I would say is that's just like they're done for, period. If they don't, because that just tells me like you have no financial literacy and you have bigger issues. And so yes, it feels like a band-aid to be like, hey, don't use a credit card. But honestly, that could be better. Like you're still better off. But for me, I'd be like, okay, why are we avoiding the conversation around maybe we should like understand like what assets are. Maybe we should understand the value of saving and investing.
Mm-hmm.
Maybe we should talk about maybe creating over consuming. So what are your thoughts on that? Because it's like it might be easier for me to argue like that. Yeah, get them more educated. And it's like, yeah, it's easy for me to say, like it's privilege for me to say.
Yeah.
But so I am seeing both sides, but I'm just like, man, like it doesn't sit well with me to be like the solution is credit cards bad, debit cards good. It's like, no, I feel like that's a really basic way to I feel like that's kind of like the excuse around why like you're not financially literate, and so just follow these directions and you'll never be wealthy, but you'll never be like in bad debt. That's kind of what I get the vibe when I hear some people talk about these things.
Yeah. 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 Great question. I think that I agree that, there's reason that credit card companies make billions upon billions of dollars in interest every year. And a lot of that is because they're just marketing so heavily towards the younger audience. Obviously, like I got my first credit card when I was like, 17, 18. So that's super normal. I think that some regulation in that space could be certainly beneficial. I have no idea how you could go about doing something like that, because I also come from a libertarian perspective in a lot of ways. And like, okay, well, what can we do to get the government less in less regulation? But I mean, I was just having a conversation about something very similar with a friend of mine recently. It's like, well, I want regulations to be pulled back, but at the same time, we also have to understand that there are certain things within capitalism that can be really damaging if people are only out for money. It's like, well, then we have to be able to regulate some things. And, maybe some of that is like what's going in our food, or, what's happening with different financial products, that kind of thing.
Yeah.
I don't know if that entirely answers your question.
No, it doesn't. And I think the flip side of that is it sounds good. I also am lean libertarian conservative, and it's like, yeah, it sounds great to be like, we're gonna cap credit card interest rates at blank, and all you're gonna do is just you're just gonna hurt. You're just going to, and maybe this is a good thing. Like, this is what would happen if this is the case. If they capped it like at 15%, credit card companies wouldn't lend to poor people. Okay, so maybe that's the solution. It's like, we're not going to lend to you because you're a greater risk, and so voila, you win because you're like, hey, you're not able to get in credit card debt, and it wouldn't affect people like myself and other people, and yet. I would have to think through that, because I actually think that could be a net positive. But the reality is, if you cut off credit cards from so many, like there would be a crazy, it would be a short-term financial fever, which financial fevers are good for the body long term because they protect. So that you can make this argument, like this is the first time I'm actually thinking about it this way. So I'm like, oh, that's actually that's exactly what would happen, and that may not be a bad thing. But I like what's not going to happen is the credit card companies are going to cut rates and then still lend to you. That's where I think people need to understand like the whole minimum wage conversations. Yeah, let's make minimum wage $50, and then let's see where unemployment goes kind of deal.
Yeah,
So
yeah, and I also tend to think it's like, well, if you were to, cap those credit card interest rates, what's to say that credit card companies aren't going to find some other way
yeah,
to nickel and dime people in, so that they can still bring in the kinds of profits that they
totally.
did before. It's like, well, I'm over here. I'm not like trying to put credit card companies out of business,
No, yeah.
but I'm just trying to help people be aware. What are the other options?
Yeah, I love it. I love it. All right, let's talk about credit cards, and let's talk about like the consumer protection, reward points, credit building, and purchase protection. Debit cards have that. I would love for you to speak to that. There's even debit cards that do credit building, but I think it's a poor argument because I think I think credit cards have debit cards beat in this category if we really wanted to go comparison, unless you know
Yeah.
something I don't.
Oh, no. In fact, I would agree with you on that. Like, at least by the numbers, credit cards definitely beat debit cards when it comes to rewards. They beat them when it comes to most benefits. You're going to get like that purchase protection. When it comes to fraud, that money isn't coming directly out of your bank account, but it is if you're paying for something with a debit card. And that's admittedly something that I'm not a big fan of when it comes to the debit card. And I also know that there are, fraud protections with debit cards, just like with credit cards. But there are some differences in terms of like how much you might be liable for based on when you report fraud or when you report that your card is missing or stolen or,
Right.
That kind of thing. So just by the numbers, I absolutely agree. Credit cards are better in that regard. And
Okay.
that's something to consider.
Okay. What is your thoughts on credit score and the points that I made about just like manual underwriting, insurance rates, and renting? Like what's your thoughts on the credit score? Because there are some people that go as far as to say, you know, your kid. Yeah, I mean, let's say we both have family, kind of deal, and like it. I'm gonna raise my daughter on she'll have a credit card when she's young and start building credit, and the hope is like when she's 18, not because I'm in love with the credit card system, but it's just like, hey, I think I'm gonna try to teach her to do that responsibly and try to set her up. If someone doesn't have a credit score at all and is like that, like do you think that is a good thing, or do you think that there's some negatives to that?
Well, going back to something that I said before, I'm never recommending people to sign up for a credit card. So I have a couple friends who don't have any credit cards. I'm not going to say, well, I think you should probably sign up just so that you have a credit score. Kind of like what we were talking about before in terms of just like drawing a line in the sand. I absolutely could play the game in terms of using credit cards, getting the maximum benefit out of them, increasing my FICO score, and that kind of thing. But I'm trying to show people a different way. And so for that reason, I am, like I said, we haven't used credit cards in 8 years. And at some point, we're not going to have a credit score anymore. That's not a concern for me, honestly. And the reason is because I'm planning on paying for things with cash for the rest of my life. And I understand that at, any point there could be some massive issue. There could be a medical problem, there could be whatever that could cause us to go back into debt. And if that is the case, then we'll deal with it when it comes. But at the moment, not worried about the credit score. And I'm not suggesting people to try to build their credit score because of the exact reasons that you were just talking about, 15 minutes ago, about how kind of ridiculous the credit score really is, that it's just going to increase based on how much debt you have,
It's ridiculous, but when we help people like build their wealth and look at all stages, someone that has an 800 credit score is better off than someone that's 500, from potentially refinancing to just different options. You don't have to use it, but it's like prepping. Would you rather be prepared or not be prepared? And you could say, well, the likelihood of something crazy happening is so low that it's like, yeah, that's fair. And you're probably going to be right. And I actually I respect that. And at the same time, we have a whole service that we help people better their credit score, because it's just optionality. It's just like, I would rather have more options. And I don't necessarily need to agree with the system to say, like, I still want myself and my family and our clients to have the best credit score possible, because it's like, why not? But so I just wanted to hear your thought process around that. And what I hear you saying is you don't need a credit score to live. And I agree that you don't need it. And so that can be a disagreement. My question to you is manual underwriting. So to get a home, you can get it. You don't if you don't have a credit score, you can still buy a home and use debt. Would you say that those options are worse than if you had a good credit score? Because it's hard for me to find information on it. And like when I put it into ChatGPT, it essentially said, yes, like you can get it, but usually like the options you're not going to get better options. And in most cases, you're going to have to pay a higher interest rate, which actually makes sense, because what you're just doing, it's supply and demand. You're now, instead of having the market, instead of me going to 100 options, I now potentially have 5 options or maybe more, but you get the point. And like, so by result, less options means potentially less competitive. I don't know if that's been your experience, but logic just took me down that train, and I wanted to ask your thoughts around that.
Yeah, logically, I definitely agree. The fewer options that you're going to have when it comes to purchasing a home, getting a loan, you're going to be limited on the interest rate, the lower the interest rate that you can get. I wish that I had more information on this topic, but I don't. When we purchased our home in 2020, I mean, we still had a credit score. So, when we went through the whole process, they ran our credit score and we got a good interest rate and everything. I haven't gotten to the point where, I've actually purchased a home through manual underwriting, because they're automatically going to run your credit score. Whether you tell them that you have one or not, they're gonna try to run it to make sure that you're not lying. So if you have a credit score, they're probably going to go off of that.
Would you be better off not having a credit score or having a bad credit score? This is a question I don't know. Like, would you be better off not having a credit score or having like a 580?
My understanding is you'd be better off not having a credit score.
Makes sense.
Because then you can still go back and you can show them, okay, this is how much money I have. This is my income. Okay. This is, my bill paying history, that kind of thing. And like you said, it's less convenient. But it's possible.
Okay.
It's just going to take a little bit more effort.
I've heard George Camel say this as well. And so like I've heard people say the manual underwriting, and including myself, it's hard to find info on it. So this is an open invite when you do more research on it. Cause I think if one of your messages is like, hey, you don't need a credit score to live, it would be like, I think it'd be interesting to understand that process and thoroughly, like the pros and cons. And then we might even find that there's pros. I would love for you to come back on the show and like present that. That would be, because and maybe I'll start looking as well, because it's something that I'm genuinely curious about. Like, how would someone go about that if they were financially responsible, had assets, had cash flow, but didn't have a credit score, like how that would go about and what the differences would be. So I got one more question for you, and then you can ask me questions. When I talked about debt and going off the gold standard and the Federal Reserve printing money, and the fact that every one of our dollar bills say Federal Reserve note, and that at the end of the day, big picture, whether you spend cash or whether you swipe a card, they're just two different ways of using debt. What are your thoughts on that?
Yeah, that was an interesting argument that I've never heard before. So if you would go back and just help me understand again what your perspective is on.
Yep.
Um,
So when we went off the gold standard, we before that, our dollars were backed by gold, and at the end of the day, they were a store of value. And so by having cash, they were a store of value. And since we went off of that and we started printing money, inflation, and inflation's a thing where it's like the more we print, these dollars don't really have any real value other than people have to accept them. And the Federal Reserve will print, and we saw this during COVID, like print a bunch of money and all. And there's a lot of issues that, being libertarian, we probably both would agree on, like not a fan. And at the same time, like at the end of the day, these are just debt notes that the U.S. government, like this whole system is built around debt.
Yeah.
And so if I spend cash, and I know I'm being like a little over the top, so I want to acknowledge that, and that's where I go back to like my framework. But it's like we got emotional about debt, and yet we pay cash for things, and literally on our dollar bills is a Federal Reserve note, which is a form of debt that our government prints.
Yeah.
And so the point I'm making is, we'll talk about a mortgage in a second, and like the thought processes there, but it's like, I don't know. I just see whether you pay cash or take out a loan as forms of debt. I'm not saying that they're created equal. And so I'm looking at what's affecting my cash flow, net worth, and interest rate. For example, 10% debt versus paying cash, so it's a 10% opportunity cost for me. What are the likelihood when you factor in risk that I can earn 10% or more? For me, probably not high. So I'm going to use cash in this scenario. But if I can get debt at 2%, so then it's not free, but it's a 2% conversation. And so since there's nothing, like, that's where we go into what the Bible talks about, because it's like we can point to verses and that the Bible, talks about, not being, and I'm like, okay, but if we want to get super technical there, then we have to understand, like, what is debt? And we're not carrying around gold anymore. We're carrying around dollar bills are getting less valuable because they're literally debt instruments that we're continuing to print.
Yeah. Yeah. When it comes to that, I think the main thing is just like, okay, what's available to us? It's a very niche argument. I suppose I would say, and I know that you already acknowledged that. At this point, it's like, well, okay, what would we pay with? We're not, like you said, we're not going around paying for things with gold. We're not going around paying for things with other commodities like oil. So for that reason, it's like, how far can you go? And it all.
Yeah, I just use it as an example purely to say that we say debt is dumb, pay cash. And all I'm saying is you can make the argument that paying cash is a form of debt. That's all I'm saying. I'm not saying that no one's life is better because I just mentioned that, of like, oh, now I'm just literally like, it's a way for me to just say, like, okay, sometimes we take that paying cash as the moral high ground, and it for sure is the potentially safest way to use debt, but it's still a form of debt since we went off the gold standard. That's all I'm saying. And, and so we can move on. Do you have any questions for me? I know I've been kind of going through, but any questions before we dive into the next segment?
Yeah. If you would, just like, so going back to something that you said during your initial 10 minutes was about, how the vast majority of people aren't considering the risk associated with debt and especially with credit cards. Totally agree. Would you kind of expound on that a little bit more in terms of like, what do you think are some ways that we as like personal finance education people can help people understand risk and, how that can impact them long-term when it comes to their finances?
Yeah. Yeah. It's interesting. Warren Buffett has 2 rules to investing. Number 1, don't lose money. And number 2, listen to rule number 1. And when you start looking at like what the wealthy people do, they care less about making greater rates of return and more about making market rates returns with reducing risk. So anytime you talk to very sophisticated people, they're way more aware of the things that could go wrong. And I find that I appreciate when I'm talking to anybody, any type of investment, any type of business opportunity, any decision, if you're not going to tell me the cons, it's really hard for me to like get behind you as a person, because it's just like, well, I just love when people can be like, here are the pros and cons to any type of decision.
Mm-hmm.
And so what I find is and this will tie back into the issue, is a lot of times younger people in general are just not thinking about things that could go wrong. They're not thinking, okay, like, and I think of risk in investing as your chance of loss, but risk when it comes to consuming is just like, why did you think you could buy that thing? And I will say that debt can be an enabler. For example, just because you can afford a home with a 30-year mortgage doesn't mean you should get it. You and I both agree on that.
Yeah.
And so what I'm not saying is I endorse you maxing out your lifestyle, and the only way that you were able to max out your lifestyle is 30-year mortgage. So someone could be like, oh, I got you. Maybe. But it's like, for me, that's where I separate it on what are you going to purchase, and is that purchase going to be a net positive or negative? So when it comes to an asset, when I invest my money, where are the opportunities for this to go south? And with knowing all those things to go south, am I still willing to part with my money? When it comes to buying a car, same thing. When it comes to buying a home, where are all the home ownership is like a disaster. It's like, it's like, why do we buy homes? I have no idea. Definitely not ahead in that category. And so thank goodness I'm not over leveraged. Thank goodness. Like, I don't say this as like a humble brag and all. I really don't. Like, we could have paid cash for a home. So all that just tells you is I'm grateful for the home that we're in, but we could have easily gotten a 5, 6, 7 times nicer home. Mm-hmm. And I would look flashier on paper. And I'm like, as a business owner, it's like, why would I want to do that? I would feel way more at risk, because then if we have a bad couple months and all that stuff, now I have like a greater stress on my cash flow. It's easy to bundle those two things together and say, Caleb, we'll just pay cash for something and all that stuff. And like, I'll give you that. But I'm like, okay, if we could actually take it a step further, it's not the debt's not the issue. Debt's not the issue, in my opinion. It's the decision that's the issue, and maybe debt was an enabler. So we need to acknowledge that. But that's where I'm like, there needs to be a set of decisions, and like, your framework is, if don't use debt to purchase something, and voila, you're already going to live below your means. I'm telling you this, I have cash that I still would not pay for a car, like a $100,000 car. I may have the cash to buy it, but like, why in the world? Like, that would be, I would never do it. In fact, I bought my wife a used car with a dent in it, which is like laughable, but it's like, that's just like, it was a great value, blah, blah, blah. And it's like, so just because we had the cash doesn't mean, so that's for me, it's like, you save the first 50% of Americans, like, boom, just by like, if you don't have cash for it, don't buy it, you save them. But like, then you get to a place in your financial life where it's like, even if you do have cash for it, doesn't mean you should buy it. Just because you have an extra $10,000 a year doesn't mean you should go on a $10,000 vacation. You should understand the consequences of paying $10,000 for a vacation, and how that actually will cost you hundreds of thousands of dollars over your lifetime. So I don't know if I'm just talking to talk, but those are like the two. The risk aspect is actually in what you're purchasing, and then debt is the enabler if you're not thoughtful about the first step. But debt for me is like for example, buying a car. I'm a fan of using car debt. Like, I am. Like, a lot of times what people say is don't use debt for a liability. Well, it's like, number one, don't buy a dumb car. Don't buy a car that is outside your price deal. But if you're going to buy a car, and you're going to buy a car, and let's say the car's $20,000, and you have the option to use debt for it, that's at least an option that I would want to see and compare it to paying cash. Now, the last 2 cars that we've purchased paid cash. So what does that tell you? It told you that I looked at both options and I chose to pay cash, whether it was for convenience or whether it was just, for me, it was for the convenience aspect. But it's like now at 7-8%, you could make the argument of like, I guaranteed 8% pay cash. Whereas car rates at 2%, I would make a different decision. And it doesn't make me a hypocrite. It just makes me consistent with the framework of decide what you're going to purchase, understand risk. And then when you purchase something, understand cash flow, net worth. And also, are you increasing your risk? And I would argue that sometimes you're decreasing your risk by using debt.
Yeah. Okay. Well, I totally, I'm following what you're.
You hear me? You don't agree, but you understand where I'm coming from.
So I think one of the major things that I would like to point out, and this is something that I've kind of touched on before, is like, okay, the differences in terms of like the people that we're talking to,
yep,
is like totally different segments. So I understand what you're saying. I agree mathematically because I'm an engineer. I'm all about the math.
Yep.
And I follow all the math when it comes to people talking about leveraging debt in order to increase their wealth in the long term and everything like that. Totally get it. That's not my audience that I'm talking to, which is why I have to be, which is why I have to put that line in the sand and be able to, stay consistent, if that makes sense.
I agree. Do you agree that there's a difference between good debt and bad debt, or is all debt for you bad debt?
So if I had the cash, I would tell you I would pay for everything with cash.
Yep.
Having said that, I will say that, like purchasing a home, we bought our home in 2020. That was like a great time to buy a home because our home equity has gone up massively in the last 5 years. It's hard to argue against the benefits of purchasing a home at the right time under the right conditions, not over leveraging yourself. It's hard to argue with purchasing a home with a mortgage and that not being a good thing. But the caveat is that if I had the cash, I'd buy it in cash. Every time I would buy it in cash. And part of that has to do with, going back to the risk aspect. I personally am incredibly low risk.
Yep,
and
me too.
Like we still invest, we're still putting money into the stock market.
Yeah.
But I sleep better at night knowing that the only debt that we have is our mortgage and we aren't over leveraged and we have an emergency fund. And, all of that goes into like my psychological health is so much better knowing that that's where we're at.
Yep. Do you want to talk about the mortgage right now or do you want
to? Sure, we can talk about it.
Okay, let's talk about the mortgage right now. Do you, just clarifying question, did you build your emergency fund up before you started aggressively paying off your home?
Yep.
And can I ask how many months of emergency
it
was what your baseline was?
Yeah. So going back to 2020, we ended up saving up a 20% down payment after we saved a 3-month emergency fund. At the time, we had pretty low bills and everything. So we just decided to go with a 3-month emergency fund. I wasn't too worried about it in that regard. Once we bought the home, the home has a tendency of breaking. So we decided to bump up our emergency fund by, like a month and a half. So we were at like 4.5 months for a while. Then mid 2023, we had our son. And at that point, it's like, okay, I've got another mouth to feed. And it's not just another mouth to feed. It's a mouth that can't go out and get a job and earn income. It's like,
son, you're a liability, brother.
Yeah, exactly. Exactly. The most fun liability ever. So having said that, I'm at that point, I was like, okay, we need to increase our emergency fund beyond that. So at that point, we bumped it up to 6 months. So I say we have an emergency fund of 6 months, and it's true. We actually have probably closer to a year total. And that's just because like we've got our emergency fund, and then within our budget, we have a ton of sinking funds. And it can, it's anything from our HVAC. Our HVAC fund has like $2,000 in it.
Yeah.
I'm a budget nerd, so I'm like, let's make a sinking fund for every possible
I
little
love that.
thing.
So you have like a digital envelope system.
Yeah, exactly.
Great.
I hate the idea of actually having to use my emergency fund. So I'm like, we have our emergency fund, and then we have all these sinking funds, which are essentially emergency funds for
they're like insurance for your emergency fund.
Yeah,
like
exactly.
What type of rate of return are you getting on your emergency fund?
That's 4%.
Okay, got it. Okay, all right. So awesome. And then back in 2020, you got a 15-year mortgage, and you're aggressively paying it off. Interest rate under 3.
Yep, 2.99.
2.99. It's incredible. Yeah. Okay, all right.
And I'll preface this by saying, again, I get the math.
I know the engineers, but yeah.
30. I understand why people are like, don't pay it off. Just use the extra, invest.
Yeah, and Dave Ramsey says when you have a paid off home, the backyard feels different. Just feels different.
Yeah.
Is it so? You'll acknowledge that we could easily go down the net worth and cash flow conversation.
Oh yeah.
And you would acknowledge that even in your high yield savings account, the arbitrage is undeniable. So you get that. Okay.
Yep.
So then I'm only going to talk about the risk. I'm not going to talk about, Dave Ramsey. One of the things, I love him. I just want you to know that. And there's a couple things that I'm like, okay, I would love to have a conversation around this. Like, he's so adamant about his mutual funds. He's all in on mutual funds, not even index funds, mutual funds. And yet, but he's all like, and it's just like, okay, you're telling me 12%. Don't even get me started on your distribution rates on retirement, Dave. But then you also are like adamant about like paying off. And that for me is just like, it's like, and then you talk about risk, but then you maybe not talking about risk on the other side. So it's like, but I appreciate that you're like, hey, engineer, get the math and all. So let's talk about risk. I get anxiety. Like, I just want you to know, like, I'm going to make the argument that you are creating more risk for your family by the decision versus if you did a 30-year mortgage. We'll see. You don't have to agree with me. This is going to make me like, I'm hoping that I can get this across and you'd make me super happy if you can at least acknowledge my opinion. Yeah. Okay. So I love the fact that you guys, the 15-year mortgage, like, don't buy a home if you can't pay it off in 15 years. I want to just, that I endorse that, even if you bring that down. I think I talked to someone recently that their belief around what the Bible says is like, if you can't pay for something in 7 years, you probably shouldn't buy it. And I was like, yeah, I'm going to look into that. I like the sound of that. I have to do more research on that. So all that to say, it sounds like you are in a home, like you could probably have bought a bigger home and this process got you in a smaller home, and such is going to benefit you guys just because you're not over consuming. Now, again, we won't even talk about the interest rate of 3% and where that could be spending the difference in earning. Right. We'll just look at risk. So when I think of risk, I think of, okay, when it comes to risk management, what's the greatest risk that you have in your life right now? Greatest risk that you have in your life for your family is you dying prematurely, you getting disabled, or you losing your job. Those are the three big risks to your family, because I would make the assumption that you're the main wage earner. Yeah. I'll make the assumption that you also have life insurance as well. So, okay. So that's like, from that standpoint, let's say you don't die because, life insurance would kick in and all. So let's say you lose your job, or let's say you get disabled and you're not able to work. Okay. So now you're in a situation that you have, let's give you you have a year's worth of emergency fund, which is great. But like, you have all this money in a home, and guess, like, in some people like, oh, you could go refinance or go get home equity. You probably wouldn't do that because it goes against your ethics. But even if you tried to go do that, banks don't love loaning money to people that don't have jobs or can't work. Yeah. Kind of deal. And so it comes down to the philosophy around where, like, if I have a belief that more options are better than less options. Now, I will say that more options to the wrong person can be problematic, but I'm talking to you right now. And I know You're the type of person that is literally creating sinking fund, like digital envelope system. Okay. I'm not worried about you. I'm not worried about you like going on a spending spree. Okay. So with that, and again, this the fact that you're a 3% even makes this even more perfect is like, okay, in a world where you got your home, if you did a 30-year mortgage and all you did was just save the difference in a high yield savings account, nothing like you're just building an emergency. Yeah. Long run from an interest rate standpoint, you'd be ahead. But from a risk management standpoint, you now have potentially 15 years or so of payments, 20 years of payments, and that just gives you options. It gives you optionality, but also it gives you the ability to potentially go get that medical procedure that maybe not covered by insurance, or it might give you the ability to move, or it might give you the reason banks give you lower interest rates on 15 years is a 15-year mortgage is actually better for the banking institution than the 30-year, because from a lending standpoint, they get their money back, so it's less risk for them. The 30-year mortgage is an insane product that I have no idea why the US, most countries don't do 30-year fixed rates because of and the reason why banks and credit unions they all sell it off is that they couldn't stand to keep that risk on their books. So I just look at the 30-year tool. Even if I wanted to pay it off quick, I would take the 30-year, pay, and then save up in a savings account. Even if the interest rate on the mortgage was higher than my savings account, I would get to a point where I could have the choice to pay the whole thing off if I wanted. But I would much rather have I almost think of it as oxygen. Like right now, you have a year's worth of oxygen. I may have 10 years of oxygen. I would much rather have the 10 years of oxygen and maybe pay a little bit more of interest rate, because my interest rate's higher than yours. But and there might not even be the spread. I'm also earning that 4.5%. My mortgage is higher. I'm actually still okay with that. Not because I'm going to make weird math and say I'm ahead, but I'm just like the opportunity cost and control that I have and the peace of mind that I have to say, like, I have years of not just mortgage payments, but optionality. And so so for me, that's when I look at risk, I am with you. And for that same reason, aggressively paying off your house feels more risky to me for the points that I made.
Yeah. And I totally understand that. I think everything that you said makes a lot of sense to someone else, who's very, very risk averse. I think the first thing that comes to mind is like, I tend to, be risk averse, and I'm going to try to make sure that I have as much buffer between me and the street. But at some point, and I can't even really tell you, like, this is for sure where that line is in my head, but at some point, I'm comfortable with the minimized risk versus the super minimized risk, if that makes any sense.
Yeah.
So at least when it comes to like a 15-year mortgage versus a 30-year mortgage, I agree mathematically. Going ahead and like saving back that money so that at some point maybe you have enough money in your bank account that you can just pay off your mortgage, but you're going to keep it for, just in case something happens. The problem is, and of course, this is just you and I talking right now, but the vast majority of people aren't going to do that.
I agree. And, with that. Yeah, I'm talking to you right now.
Yeah, exactly. Exactly. And the concern is like, okay, for the majority of people who maybe don't have that type of discipline, or at least have not exercised that discipline in a way that they're, managing their money and budgeting on a regular basis and reducing their spending and increasing their income and that kind of thing, then that extra money just gets absorbed in random stuff that doesn't, ultimately benefit their life.
Another way to say that is creating a forced savings is potentially a good hindrance because you're going to spend the difference.
Yeah, exactly.
Yeah,
Exactly.
I agree.
And
But right now I'm talking to you, and I'm saying like, why are you paying extra on your 15-year mortgage and not just putting it into a high yield savings account when you're earning more, and you'll actually pay off your home faster if you just did that versus paying off a 3% debt. Like you'll actually
yeah,
get debt free faster if you just put money into a side account. And like the reason why accredited investors have a thing is a lot of times investments are less liquid,
hmm
and that less liquidity is a risk, and hence why sometimes they won't let average people invest in it. I
yeah,
see paying off your home as just like the same concept, is like you're putting money in and like you're literally getting less value. Your high yield savings account would give you more value, more options, help you pay off your debt faster, and yet there's something emotional about why I'm paying, and that's why I just want to better understand of like,
yeah,
yeah,
yeah. So honestly, it all comes down to consistency. I have a specific audience that I'm talking to.
yep,
I don't ever want to come across as being hypocritical, and not
yeah,
by no means am I saying that you're being hypocritical in any way.
yep,
But what I will say is I'm trying to help people who are really, really hurting in significant ways change their personal finances for the better. Some of that, in my belief, is going with a 15-year mortgage that, yes, maybe mathematically it increases your risk by virtue of the fact that you no longer have as much cash every month, for any sort of emergency that might come up. But it's also like, I'm not recommending that everyone go with a 15-year mortgage who can't afford a 15-year mortgage. I'm recommending to go with a 15-year mortgage that's actually still going to be like comfortable within their budget,
yep,
And if you're still going with the Ramsey baby steps, that's going with a 15-year fixed rate mortgage that's, where your payment is no more than 25% of your take home pay. Like people are going out there purchasing 30-year mortgage, homes with
yep.
30-year mortgage where their payment is, 35% of their take home pay. And that is, mind blowing to me. So
I get it. Yeah.
ultimately it just goes back to consistency. I'm
Yep.
trying to show people I could do this. I could arbitrage this, but
Yep.
I'm not going to, because I want to show you that it's possible to do it this way.
And Dave Ramsey was asked, would he be given a Bitcoin? Would he accept a Bitcoin if he was given it? And he said no, for that same reason, consistency. He was
Yeah.
also asked, I think, if he was given this massive loan interest free, would he take it? The answer is no. He's a smart guy. He knows he could put that money in treasuries and
Yeah.
make, consistent. So I respect that, because I think you're actually like, in the grand scheme of things, I'm like dialing in on you. And in the grand scheme of things, it's like, I can see the argument of like creating a forced plan. You avoid making mistakes. I'm just saying like for people like you, for people that are like money nerds, for people that are like real responsible, like I actually, like, part of me, like, it's interesting to me because we look at the same companies that are like the credit card companies, the
Uh-huh.
banks and they're actually like, you're helping them be more profitable because you're paying back a loan on the book. A loan is an asset for them at 3%. You're paying that faster so that they could go loan out that money at 7%.
Yeah.
And so it's just for me, it's just like, I made my point, and I think you heard. I feel acknowledged, but I also feel like I didn't accomplish what I wanted to accomplish. I wanted to convince you to say, hey, just pay high yield savings account. Don't overpay on your 15. Keep your 15, and then pay off your mortgage faster, because mathematically that would be possible. And then
Uh-huh.
invite me over for the mortgage burning
Yeah. Yeah.
deal,
Yeah.
and
Yeah.
like we could celebrate faster, and you'll
Yep.
be safer along the journey. But
Yep.
I do appreciate principles. Any other point that you want to make before we go back to, we could talk about, as Christians, what like from a Christianity, from a debt standpoint. But is there any other point that you want to make, or anything else on the mortgage? Because I think I talked about all the things that I wanted to acknowledge as it relates to that.
Yeah, I think that I was able to communicate everything that I wanted to. I think the main thing was just like going back to, um, yeah, reducing risk, great. Reducing risk to an unbelievably small amount. At least in my head, maybe, um, I'm not at that point where I feel like I need to build up a 10-year emergency fund, just because of what might happen. I think,
Yeah.
going back to, and I'm sure that you would agree with this coming from Christian perspectives, we're called to still, put our trust in God. And, that means being, you know, good stewards of what he's given us and, creating that buffer in our lives that we need,
Yep.
but ultimately still trusting that he could, anything could happen in our lives that could take everything that we have away. And there's, parables in the Bible that illustrate that. But, and at that point, we have to trust that he's
Yeah,
still
but
going.
the Proverbs also talk about like story, like there's also parables of like a wise man,
Yeah,
and
absolutely.
does certain things for that.
Yep.
But you're not wrong. I think the aspect is you never want like it's the love of money that can be the
Hmm.
issue, and you never want to get to a place where you're trusting less in God because you're financially at a point.
Yeah.
But to be fair, like we're both creating content to try to better people's lives, and I would say that, so I'm totally with you, but I'm in the camp of be the best steward you can be, because regardless if it's like less risk, more net worth, more cash flow, a generous person with those scenarios are going to give more. A non-generous person, it's not going to matter.
Yeah.
And so that's another thing where it's like a lot of times people wait to be financially in a place before they start giving, and
Hmm.
I think that's also a mistake. It's a I appreciate you breaking that down. There was one other thing that I was going to say and I forgot. It was good. It was so good. I forgot it. Oh man. Well, let's move on, and I may remember it. When it comes to just we talked about, is there such a thing as good debt? You don't I would say no, but you would say that there's worse bad debt. So if you were to
Yeah.
talk to someone and they had 20% credit card debt and a 15-year mortgage or 30-year mortgage, you would tell them to tackle the worst debt. So by definition, there's worse bad debt.
Yeah.
I could say my definition of good debt is something that helps you increase your cash flow,
Mhm.
increase your net worth, and reduces your risk. And I do believe that's possible to do. And I believe if you can accomplish all three of those, that's good debt. If you can only accomplish two out of the three, I would put that in the bad debt category. So that's a conservative aspect, but that's my definition of good debt. And I do think there's examples like the example in the mortgage where you could potentially, for myself, you could actually say like I think it would be irresponsible to try to pay this off or take this off of my balance sheet. Like I feel like I'm better off having this option as in my financial plan versus not. So
Yeah.
I think
Yeah. And
yeah.
I totally understand that argument.
Okay. All right. So then the last point we'll talk about are credit cards, more harmful than good. And I would say this is the point that I would say is if I had a magic wand and we could erase credit cards, period, and everyone goes back to like using debit card concept, I would say that it would be better net for society for no one, like the upside of people having points and all these things. If everyone, if they didn't have the ability to have 20% credit card debt and we all use debit cards, I I think we would be better off as a society in that. And so I'm acknowledging that. But that still means like, okay, if the credit cards are an option, I'm gonna approach it the same way. Was what's the more efficient way? My definition of efficiency is removing any friction to get to where you want to go. So the bet that I'm making personally, and a lot of our clients are making personally, because we actually have a service that we do in our coaching, which will like help them optimize their credit card points, kind of deal. And in those type of scenarios, we're saying, okay, with your inputs, we're creating a scenario where your benefits are greater than your input. But you have to factor in all that, which may include overspending. So you have to factor that in. But I
Yeah.
think if you zoom out in society, and you say, are credit cards a net positive or net? I think the fact that we have over $1 trillion of credit card debt, over 20%, and you look at where most people, like, I couldn't look you in the face through this camera and say that credit cards are a net positive. So you tell me if I'm hypocritical by using credit cards, and it's like, you can make the argument, are we better off having the internet? I think we are. Our phones, are we better off having phones? I think there's a lot of problems with phones.
Yeah.
But I still have one because I'm not going to not use it. And so that's the example that I would use is does it make me hypocritical? Maybe, but that's where I can stand by I'm going to use credit cards. And if I had a choice, and if I could be like all knowing and like make a decision, and I could choose like wipe out all credit cards versus use them and be in the situation, I probably would have us all use debit cards. And I think in the long run, it would be a fever, but I think in the long run, people would be better off.
Yeah. I would agree. I think ultimately, just by virtue of the fact that there is, over $1 trillion in total credit card debt, is an answer to that question. I don't think that, if we could go back to the 50s and not have credit cards anymore, then I think that would be ideal. Just because then it wouldn't have built up to this point. It's like, if you were to eliminate them right now, that would be, virtually impossible, just because of how much our society is built on credit. But I know people that will say that, just by using credit cards, then you're enabling credit card companies to, be predatory in way when it comes to like giving credit cards to people who they know they're going to make a ton of money off of because they aren't paying it off every month.
Yep.
I am not someone who's like going to make the moral argument against credit cards. I don't think that you're a sinner because you use credit cards.
Yeah.
I think that you're a sinner because you're human,
Right.
So,
yeah.
So I'm not going to make that argument, and I'm also not going to, say.
But
that
I think that's actually that could be an argument that you could, build off of. I think you could, if there's something that is harming society, and you are creating supply and demand and funding it. I mean, we would, if you get extreme, if like we probably both would be very against our money or benefiting anything to do with the pornography industry.
Yeah.
So I think it'd be like, that would be, or anything that's like trafficking kids, nothing to do with it. But, I own Nikes, and they're not necessarily awesome when it comes to their track record on child labor.
Yeah.
That's problematic. Like, I'm letting you know that this is it's not like a black and white thing, but maybe it should be. And for some people it is. And I'm more aware, and that's changing the way that I'm making decisions. And going forward, I'm trying to wear clothes and be more thoughtful about that. But I'm not judging everyone that's like, oh, you support, child labor if you wear Nike. Like I haven't gone that far, but there's people that make that argument, and I respect their opinion. And I think that could be a conversation to say, hey, Caleb, like it goes back to a drinking analogy. It's like, you might not have a drinking problem, but by you drinking, you potentially could be enabling or causing your friend over here who does have a problem to slip in because they respect you. And they're like, well, if Caleb is, and so I think that's where we may be able to end it, because I think that's a good thought question. And I just want to thank you all for watching. Like, really appreciate you watching this entire video. Would love to hear your comments. Like, keep it, critical, like just keep it polite, but I would love to hear like, what are points that were made? I know that, Caleb, not only do I love your name, but you made some really, really good points, and I appreciate that. And I hope that my audience can support what you're doing, and go subscribe to your channel. I would love nothing more to get you over 10,000 subscribers. And just the work that you're doing. Like, we need more people talking about these things, because more conversation is better than less conversation. And so we'll make sure to put all your information in the comment or in the description below, and make sure that it's people will be able to find your channel. Is there anything else that you want to say, or any call to action that you have for the people watching this video?
Just thank you so much for having me. I thought that this is a great conversation. It's not very frequently that I get to have this kind of conversation with someone else, especially within the finance and the content creation realm. So yeah, this is great. I really respect your opinions, even if I don't necessarily agree with everything. I think that where you're coming from is very logical, and that you got to stick with what you believe ultimately. So
see, it's possible to have disagreements and not hate each other. It's like, shocker. It's like, maybe that's the takeaway that people have, is like, hey, maybe you can have conversations with people, actually seek first to understand and learn. And I hope that the internet and the finance community is better off for this conversation. And if you're work at Dave Ramsey's organization, like if you know Dave Ramsey, can you put in a word for me? Because I would absolutely love to chat with him. And please, I'm not here to try to get any, like, I would just be an honor to be able to sit down with people that have made such a big difference. And yeah, don't 100% agree with all the things that he says, but I have tons of respect, and that I try not, hopefully that's not hypocritical. And he helped me on my journey as we went through Financial Peace University when I was in high school. And that and reading The Richest Man in Babylon were like the two things that really got me interested in this whole money space. And I'm arguably doing what I'm doing now because of those influences early on. And so for that, I'm very, very grateful. And Caleb, I'm looking forward to continuing to have you in my life. And I want to have you back on when you do a deep dive on manual underwriting for home. I'm excited to learn more about that.
Yeah. Now, hopefully I can get you on my channel at some point as well.
I would love that.